Standard 4. Do you have problems in learning accounting standards?
Don't worry, we got your back.
So, are you ready? Let's start.
So the first standard is the PFRS 5, which is the non-current asset held for sale. So what is non-current asset or disposal group classified as held for sale? It is an asset that intends to sell and recover the carrying amount principally through sale. The objective of this standard is to specify the accounting for assets held for sale and the presentation and disclosure of discontinued operations. Its classification and presentation requirements will apply to all recognized non-current assets and to all disposal groups of an entity. There are a series of measurements for this standard, but before an asset is initially classified as held for sale, it is measured in accordance with the applicable PFRS. Or when non-current assets or disposal group are classified as held for sale, the entity shall measure it at the lower of its carrying amount and fair value less cost to sell. When a sale is expected to occur beyond 1 year, the entity shall measure the cost to sell at their present value. Any impairment loss on any initial or subsequent write-down if the asset or disposal group to fair value less cost to sell. Any subsequent increases in fair value less cost of an asset, it can be recognized in profit or loss. Any impairment loss recognized for a disposal group should be applied, and non-current assets or disposal groups classified as held for sale should not be depreciated. Aside of those stated already in Pass 1, these are some disclosures needed, which are the description of the non-current asset or disposal group, description of the facts and circumstances of the sale or leading to the expected disposal and the expected manner and timing of that disposal, and gain or loss recognized and if not separately presented in a statement of comprehensive income, the caption in the statement of comprehensive income should include the gain or loss. Also, this discontinued operation is included in this standard, which is a component of an entity that either has been disposed of or is classified as held for sale. It also represents a separate major line of business or geographical area of operations. It is a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations. It is also a subsidiary acquired exclusively with a view to resale. It is presented in a statement of comprehensive income in a single amount comprising the after-tax profit or loss of discontinued operations and the after-tax gain or loss recognized on the measurement of fair value less cost to sell or in the disposal of the assets or disposal groups classified as discontinued operations. These are the disclosures of the discontinued operations, which are the single amount in a statement of comprehensive income comprising the post-tax profit or loss of discontinued operations and the post-tax gain or loss recognized on the measurement of fair value less cost to sell or in the disposal of the assets or disposal groups constituting the discontinued operation. Also, the analysis of the single amount into the revenue, expenses, and pre-tax profit or loss of discontinued operations and the relaxed income taxes, and the gain or loss recognized on the measurement to fair value less cost to sell or the disposal of the assets or disposal groups constituting the discontinued operation and the related income tax expenses. Also, the net cash flows attributable to the operating, investing, and financing activities, which is to be presented either in the notes or the financial statements. And lastly, the amount of income from the continuing operations and from the discontinued operations attributable to owners of the parent, which will be presented either in the notes or in the statement of comprehensive income. It is to be noted that the retrospective classification as a discontinued operation where the criteria are met after the statement of financial position date is prohibited by PFRS. The next standard is PAS 41, which is agriculture. For definitions to start with, biological assets are living animals and living plants. Agricultural produce is the harvested product of an entity's biological assets, A harvest is the detachment of produce from a biological asset or the cessation of a biological asset's life processes. And lastly, an agricultural activity is a management by an entity of the biological transformation and harvest biological assets for sale or for conversion into agricultural produce or into additional biological assets. The objective of this standard is to prescribe the accounting treatment and disclosures related to agricultural activity. The scope of Task 41 is applied to account when they relate to agricultural activity, biological assets except for bearer plants, agricultural produce at the point of harvest, and government grant related to biological assets. For biological asset, it is to be measured on initial recognition and at the end of each reporting period at fair value less cost of disposal. For agricultural produce harvested, it is to be measured at fair value less cost of disposal at the point of the harvest. And lastly, for agricultural produce growing on bearer plant, it is to be measured at fair value less cost of disposal. An entity shall recognize a biological asset or agricultural produce when an entity results the asset as a result of past event, when it is probable that future economic benefits associated with the asset will flow to the entity, and lastly, when the fair value of cost of the asset can be measured reliably. There are many disclosures needed for this standard, and it is divided into four: for general, additional, and when the biological asset is measured at cost less any accumulated depreciation and any accumulated impairment loss, and for the reconciliation of the changes in the carrying amount of biological assets between the beginning and at the end of the current period. But first, we'll go to general disclosure. It is to aggregate gain or loss arising during the current period on initial recognition of biological assets and agricultural produce and changes in fair value subsequently. And lastly, the narrative or quantified description about a group of biological assets, the nature of activities, the maturity and immaturity for intended purposes of each group, relative significance of different groups by reference to non-monetary amounts dedicated to each, and non-financial measures or estimates the physical quantities of each group of assets at the date of the statement of financial position and the output of agricultural produce during the reporting period. Next are the additional disclosure, which are the measurement bases used to derive fair values, an independent appraiser whether it was utilized, the discount rate employed to compute net present values, the additional details about the changes in fair value from prior period. Next is the any restrictions on title and pledging of biological assets of security for liabilities, the commitments for further development or acquisitions of biological assets, the specifics about risk management, strategies employed by the entity, and the activities which are unsustainable, along with estimated dates of cessation of those activities. Next is when the biological asset is measured at cost less any accumulated depreciation and any accumulated impairment losses, which are the separate reconciliation of changes in the carrying amount of biological assets, the description of the biological assets, the explanation of why fair value cannot be measured reliably, the statement of the range of estimates within which fair value is highly likely to lie, the amount of any gain or loss recognized on disposal of biological asset, the depreciation method used, the useful lives of or the depreciation rates used, the gross carrying amount and the accumulated depreciation, the accumulated impairment losses at the beginning and at the end of the reporting period, the description of the biological assets, and lastly, the fair value becomes reliably measured and the effect of change in the accounting method. Lastly, for the reconciliation of the changes in the carrying amount of biological assets between the beginning and the end of the current period are the gain or loss arising from the changes in fair value less cost to sell, the increases due to purchases, the decreases attributable to sales with accordance with the PFRS 5, the decreases due to harvest, the increase resulting from business combinations, And lastly, the net exchange differences arising on the translation of financial statements into a different presentation currency and on the translation of a foreign operation into the presentation currency of the reporting entity. An example of a biological asset, agricultural produce and products that are a result of the processing after harvest is that biological asset is dairy cattle, agricultural produce is milk, and its product is cheese.
Hi, I'm Rica Mae Tantoy, and I'm going to discuss PAS 32, which is Financial Instruments Presentation. So the objective of the standard is to establish principles for presenting financial instruments as liabilities or equity and for offsetting financial assets and financial liabilities, which PAS 32 addresses this in a number of ways. First, by clarifying the classification of a financial instrument issued by an entity as a liability or as an equity. Second, prescribing the accounting for treasury shares, an entity's own repurchased shares. And the third is prescribing strict conditions under which assets and liabilities may be offset in the balance sheet. Take note that PAS 32 does not tell us how to account for financial instruments, how to measure them, and how to apply hedge accounting, because these topics are covered by PFRS 9 or PFRS 7. So what is a financial instrument? A financial instrument is a contract that gives rise to both financial asset of one entity and a financial liability or an equity instrument of another entity. So there must be a contract between two parties. This agreement has some clear economic consequences, and also the party to it cannot avoid a contract. An entity could be anybody, an individual, a partnership, an incorporated body, or a government agency. So next is financial asset. A financial asset is any asset that is a cash, an equity instrument of another entity. Example of this is shares, and a contractual right to receive cash or another financial asset from another entity, and to exchange financial assets or financial liabilities with other entity under the conditions that are potentially favorable to the entity. And a contract that will or may be settled in the entity's own equity instrument and is a non-derivative, for which the entity is or may be obliged to receive a variable number of entity's own equity instruments. And a derivative that will and may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of entity's own equity instruments. Let us also know what is financial liability. A financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity. Example of this are payables and other debt instruments. This is also a contractual obligation to exchange financial assets or financial liabilities with other entity under conditions that are potentially unfavorable to the entity. And lastly, a contract that will or may be settled in the entity's own equity instrument and is a non-derivative. For the purpose of the entity's own equity instruments, do not include instruments that are themselves contracts for the future receipt or delivery of the entity's own equity instruments. Putable instruments classified as equity or certain liabilities arising on liquidation, classified by PAS 32, is an equity instrument, not a financial liability. So next, we have equity instrument. Equity instrument is any contract that evidences a residual interest in the asset of an entity after deducting all of its liabilities. Because if we take asset from some of the company and deduct all of its liabilities, the result is the equity. So let's move on to presentation of financial instruments. So if we acquire or issue financial instruments, then we need to classify it on initial recognition as either financial liability or a financial asset or an equity instrument. in accordance with the substance of the contractual agreement. In the perspective of the issuer, if there is a contractual obligation to transfer the economic benefit, cash, or another financial asset, and if it issues a fixed number of its own shares or a variable amount, it is classified as a financial liability. Example of this is a preference share. On the other hand, if there is no contractual obligation to transfer the economic benefit, cash, or another financial asset, or if it issues a fixed number of its own shares for a fixed amount, it is classified as an equity instrument. Example of this is an ordinary shares. Ordinary shares don't have an obligation to pay anything where there is no such an obligation, unlike the preference shares, which is mandatory to pay dividends to their shareholders. So what if there is an instance that the form is an equity instrument but there is a contractual obligation? How are we going to account that? Well, according to the standard, when presenting financial liability or equity instrument, we should consider its substance over form. The contractual agreement should prevail. What is a putable instrument? A putable instrument is a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on concurrence of an uncertain future events or the death or retirement of the instrument holder. This is in the condition, for example, the death of the holder of that instrument, he can redeem or acquire back that instrument from the issuer if he dies. So that is a putable instrument. So now let's talk about compound financial instruments. Compound financial instruments have both a liability and an equity component from the issuer's perspective. Sometimes we have financial instruments that is a mix, or so-called a compound financial instruments. It's financial instrument that contains both an element of a liability and an equity. Example of this is a convertible bonds. In presenting this, since it contains both elements, it should be presented separately. So the loan element is shown as a liability and equity element as in equity. Even if the entity acquires shares or buys shares, these shares can never be presented as a financial asset. Instead, acquisition of treasury shares is directly deducted from the equity. So we have lastly offsetting. PAS 32 prescribes rules for offsetting for financial assets and financial liabilities. A financial asset and a financial liability should be offset and the net amount reported when and only when an entity has a legal enforceable right to set off the amounts, and if it intends either to settle a net basis or to realize the asset and settle the liability simultaneously. So these conditions must be met in order to offset financial asset and a financial liability. The next standard that I will be discussing is PAS 28, Investment in Associates and Joint Ventures. The objective of PAS 28 is to prescribe the accounting for investments in associates and to set out the requirement for the application of equity method when accounting for investments in associate and joint ventures. Next, we have the scope of PAS 28. PAS 28 applies to all entities that are investors with joint control of or significant influence over an investee or associate or a joint venture. So now let us define associate, joint arrangement, and joint venture. So what is an associate? An associate is an entity over which the investor has a significant influence. On the other hand, joint arrangement is an arrangement of which two or more parties have joint control. And lastly, the joint venture is a joint arrangement whereby parties that have joint control of the arrangement have rights to the net assets of the arrangement. On the previous slide, we talked about significant influence. Unsa man jud ning significant influence? Significant influence where an entity holds 20% or more of the voting power directly through subsidiaries on an investee. It will be presumed the investor has a significant influence, unless it can be clearly demonstrated that this is not the case. It is the power to participate in the financial and operating policy decisions in the investee, not the control or the joint control of those policy. If the holding is less than 20%, the entity will be presumed not to have a significant influence unless such influence can be clearly demonstrated. A substantial or majority ownership by another investor does not necessarily preclude an entity from having a significant influence. The existence of significant influence by entity is usually evidenced in one or more of the following ways. First, representing on the board of directors or equivalent of the governing body. Second, participation in the policy-making process, including participation in decision about dividends or other distributions. Third is material transactions between the entity and the investee. Fourth, interchange of managerial personnel. Or fifth, provisions of essential technical information. Now let's go to recognition and measurement of PAS 28. Equity method is used in recognizing investment associate on initial recognition. The investment in an associate or a joint venture is recognized at cost, and the carrying amount is increased or decreased to recognize the investor shares of the profit or loss of the investee after the date of acquisition. The investor shares of the investee's profit or loss is recognized in the investor's profit or loss. Distributions received from an investee reduce the carrying amount of the investment. Adjustment to the carrying amount may also be necessary for changes in the investor's proportionate interest in the investee arising from changes in the investee's other comprehensive income. When is there an impairment to investment in associate and joint ventures? After application of the equity method, an entity applies PAS 39, Financial Instruments Recognition and Measurement, to determine whether it is necessary to recognize any additional impairment loss with respect to its net investment in the associate or joint venture. If impairment is indicated, the amount is calculated reference to PAS 36, Impairment of Assets. The entire carrying amount of the investment is tested from impairment as a single asset. That is, goodwill is not tested separately. The net investment in an associate or joint venture is impaired, and impaired losses are incurred if and only if there is a objective evidence of impairment as a result of one or more events. In applying equity method, there are exemptions. An entity is exempt from applying the equity method if the investment meets one of the following conditions. First, the entity is wholly owned subsidiary or is a partially owned subsidiary of another entity, and its other owners, including those not otherwise entitled to vote, have been informed about and do not object to the investor or not applying the equity method. The entity's debt or equity instruments are not traded in public market. Next, the entity did not file, nor it is in the process of filing its financial statement with the Securities Commission. And lastly, the ultimate or any intermediate parent of the parent produces financial statements available for public that comply with IFRS, in which subsidiaries are consolidated or are measured at fair value through profit and loss in accordance with PFRS 10. So in what condition an entity should discontinue the use of equity method? The use of equity method should cease from the date that the significant influence or a joint venture ceases. And also if the investment becomes a subsidiary, the entity accounts for its investment in accordance with the PFRS 3 business combination and IFRS 10. And also if the retained interest is a financial asset, it is measured at the fair value and subsequently accounted for IFRS 9. And also if the investment becomes a subsidiary, and if the retained earnings is a financial asset, and any amount of recognized in other comprehensive income, and if an investment in an associate becomes an investment in a joint venture. That is when you discontinue the use of equity method. So that's it. The next to report is Miss Gadayan.
I'm going to discuss to you PAS 24 related party disclosures. The objective of this standard is to ensure that an entity's financial statements contain the disclosures necessary to draw attention to the possibility that its financial position and income statement may have been affected by the existence of related parties and by transactions and outstanding balances with such parties. The scope of this standard is applicable to all entities, whether private or public entities. It should be applied in preparing and presenting separate and consolidated financial statements. There is a must to present in separate financial statement even though it is already presented in consolidated financial statement. This is a common misconception to some. This standard is for entities with related party relationship wherein both entered into transaction. These are the key definitions which take part in the related party disclosures. A related party. It is a person or entity that is related to the reporting entity that prepares its financial statement. It can be a natural person or artificial person. A natural person is a person or a close member of that person's family which has control or joint control, significant influence, and a member of key management personnel. Mother, father, child, spouse, and domestic partner are considered as the close member. Whereas an artificial person, it is related to reporting entity which are the parent entity, subsidiary entity, or associate. Entities enter into transactions which in return has an effect to both entities. Related party transactions is a transfer of resources, services, or obligations between a reporting entity and a related party, regardless of whether a price is charged. Purchase or sales of goods, purchases or sales of property and other assets, rendering or receiving of services, leases, and transfers of research and development are some examples that must be disclosed if they are related to the reporting entity. Key management personnel are those persons having authority and responsibility for planning, directing, and controlling the activities of the entity, directly or indirectly, including any directors of the entity. Government entities may also enter into related party transactions, which this standard applies, since this standard applies to both private and public entities. Government. It refers to government agencies and similar bodies, whether local, national, or international. Government-related entities are those entities that is controlled, jointly controlled, or significantly influenced by a government. The disclosure of PAS 24. A related party relationship could have an effect on the reporting entity's financial statements because it entered into a transaction with related parties. With this, entities, related parties, and related party transactions, outstanding balances, and commitments must be disclosed to financial statement to users so that it can be included in their assessment of risk and opportunities if they consider to invest or if they are currently invested in. If there have been transactions between a parent and a subsidiary, an entity must disclose the name of its parent or ultimate controlling party. The name of the next most senior parent must be disclosed if neither the entity's parent nor the ultimate controlling party produces financial statements available for public. Dealings with government entity and government-related entity are exempted from the disclosure requirement. Also, reporting entities that have related party transaction and outstanding balances. Management compensation. Disclosure of key management personnel compensation in total and for each of the following categories: short-term employees benefits, post-employment benefits, other long-term benefits, termination benefits, share-based payment benefits. There is no need to disclose the compensation paid or payable by the management entity. Instead, it shall disclose the amount incurred by the entity for the provision of key management personnel services that are provided by the separate management entity. Related party transactions shall disclose the nature of the related party relationship as well as information about the transactions and outstanding balances necessary for understanding of the potential effect of the relationship on the financial statements. This disclosure would be made separately for each category of related parties and would include the amount of transactions, the amount of outstanding balances, including terms and conditions and guarantees, provisions for doubtful debts related to the amount of outstanding balances, expense recognized during the period in respect of bad or doubtful debt due from related parties. Now, we're going to discuss our next topic, which is Past 37 Provisions and Contingencies. The objective of this standard is to ensure that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to enable users to understand their nature, timing, and amount. The scope of this standard applies to all accounting entities for provisions, contingent liabilities, and contingent assets. These are the key definitions of Past 37. Provision. It is a liability of uncertain timing or amount. It is recognized as liabilities because it is a present obligation and probable that an outflow of resources will be required to settle the obligation. Obligating event is an event that creates a legal or constructive obligation. This arises when a past event leads to present obligation. It must not have a realistic alternative to settle the obligation. These are the cases that must be considered for it to be obligating event. It must be enforced by law, and in the case of constructive obligation, that creates expectations in other parties that the entity will discharge the obligation. Legal obligation is an obligation that derives from a contract, legislation, or other operation of law. Constructive obligation is an obligation arises from entities' past actions which creates a valid expectation if the entity has indicated to other parties that it will accept certain responsibilities. Contingent liability is a possible obligation that arises from past events and depending whether some uncertain future events will occur, or a present obligation that arises from past events but is not probable, or the amount of the obligation cannot be measured reliably. Contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Recognition. An entity will not recognize contingent liability. It will be disclosed in the notes to financial statements as it lacks the requirements for recognition of a liability unless the possibility of an outflow of resources embodying economic benefits is remote. The entity will not also recognize contingent assets as it lacks the recognition requirement of an asset. However, it is disclosed where an inflow of economic event is probable. An entity shall recognize a provision only if a present obligation has arisen as a result of a past event. Payment is probable and amount can be estimated reliably. Provision is not recognized for future operating losses. It is considered as probable of an outflow of resources or other event if it has greater probability to more likely occur than not. Hence, if there is no present obligation, entity discloses a contingent liability. If its probability to occur is remote, neither recognition nor disclosure is made. When the effect of the time value of money is material, the amount of a provision shall be the present value of the expenditures expected to be required to settle the obligation and shall use pre-tax rate to use discount rate that reflect current market assessment. If some or all of the expenditures required to settle a provision is expected to be reimbursed by another party, the reimbursement should be recognized as separate asset and not as a reduction of the required provision. Only when, if it is virtually certain that reimbursement will be received if the entity settles the obligation. The amount recognized should not exceed the amount of the provision. Restructuring. It is a sale or termination of a line of business, closure of business locations, changes in management structures, fundamental reorganization. PAS 37 provides that the constructive obligation to restructure arises only when an entity has a detailed formal plan for the restructuring and has raised valid expectation in those affected that it will carry out the restructuring by implementing that plan. Measurement. To measure the reliable best estimate of the obligation that the amount recognized as provision, the best estimate of the expenditure required to settle the present obligation is the amount that an entity would pay to settle the obligation at the end of the reporting period, or to transfer it to a third party at that time. If the provision is dealing with uncertainties surrounding the amount, or the provision is involved with large population of items, the obligation is deemed to be estimated by weighing all possible outcomes by their associated liabilities. Also, midpoint range is used when there is a continuous range of possible outcomes and each is likely as any other. Disclosures. Reconciliation of each class of provision. Carrying amount of the opening and closing balance. Additional provisions made in the period. Used amounts charged against the provision during the period. Unused amounts reversed during the period. And unwinding of the discount or changes in discount rate. Prior year reconciliation is not required. For each class of provision, a brief description of the nature of the obligation, uncertainties about the amount of timing of the outflows, assumptions, and expected reimbursements, if any. That's all for PAS 37. This has been Aila Gadayan, and that's all for PAS 24 and PAS 37.
So hello everyone, I'm here to discuss about PFRS 2, otherwise known as share-based payments. I'm Vincent Montelibano, your host in navigating through this standard. So the objective of this standard is to specify the financial reporting by an entity when it undertakes a share-based payment transaction, which simply means that if a transaction has shares involved with it, especially for payment for goods and services, it is included here. So, first and foremost, what are share-based agreements or transactions? It is an agreement between the entity and another party that entitles the other party to receive either cash or other assets based on the price of the equity instruments or an equity instrument itself. An example for such transaction would be the purchase of land in exchange for equity instruments, specifically ordinary shares. If we are going to apply our lessons from partnerships and corporations, if we are asked how are we going to treat this transaction, we would simply just debit land and credit ordinary share capital and record it at fair value of the land. This transaction is a prime example of the application of PFRS 2 in a real-world scenario. For all intents and purposes, the aforementioned transaction would be considered an equity-settled share-based payment. We will go further into detail about what it means and its significance later on. Generally, this standard will be applied for all share-based transactions regardless if it can specifically identify the goods or services received. However, as with everything, there are some notable exceptions as this does not apply to share-based payments transactions other than for the acquisition of goods and services. This means that the transactions that involve share dividends and the purchase of treasury shares are not a part of this standard and is governed by other standards. So before everything else, we must learn a couple key concepts. Vest is the right to receive cash, other assets, or equity instruments upon completion of vesting condition. And then, vesting condition is the condition that must be satisfied in order to be entitled to receive vest, or otherwise known as the cash, other assets, or equity instruments, and can either be a service or performance conditions. Vesting period is a period in which all vesting conditions must be satisfied. An example of this would be a company that provides share options to its employees, and let's just say they are supposed to give you 10 shares in the company after 5 years of consecutive service. The vest would be the 10 shares, the conditions would be the consecutive service, and the vesting period would be 5 years. Next would be the equity-settled share-based payments and cash-settled share-based payments. In equity-settled, measurement of goods and services received with the increase in equity at fair value of the received goods or service. In case fair value cannot be estimated reliably, it shall refer to the fair value of the equity instrument. This shall be measured at grant date. While in cash-settled, measurement of goods and services acquired and liability incurred at fair value of the liability. It shall be initially recognized at the end of each reporting period and at the end of the settlement until settled. To go further into detail, in equity-settled share-based payments, there needs to be an exchange of goods or service for an equity instrument. As mentioned before, its measurement is to value it at the fair value of the goods or services received. In the event that it is impossible, we must then use the fair value of the equity instruments itself. However, if it is still unable to estimate the fair value of the equity instrument itself and reliably, we would then need to resort to measure it at their either intrinsic value or base it on the number of equity instruments that were ultimately vested or exercised. In order for it to be properly recognized, we must first determine whether it was vested immediately or until a counterparty completes a specific period of service. Vested immediately, the counterparty is not required to satisfy a specific period of service in order for it to be entitled to the equity instruments. As such, unless stated otherwise, we must presume that the service have been received by the entity and shall recognize the service in full during the grant date. However, if it is not vested immediately, we must presume that the service will be received in the future during the vesting period. As such, the entity will recognize those services as they were rendered during the vesting period. In addition, in both cases, on immediate vesting or not, there would be a corresponding increase in equity. Also, PFRS 2 prohibits subsequent total equity adjustments after the vesting date. However, what if there are modifications to the terms and conditions in the giving of equity instruments? The short answer is that those modifications will only be considered if and only if it is beneficial to its employees. If it is not, it is considered as if it never happened. The next topic would be the cash-settled share-based payment transactions. In cash-settled share-based payments, there needs to be an exchange of goods or service for cash, in which the cash should be based on the equity instrument. Measurement of such would be a debit to assets or expenses in profit or loss, and a credit to liability. The liability will be measured at fair value and will be remeasured at each reporting period until settled. For the conditions of vesting immediately or not are identical to its equity settled share-based payment counterpart. If it is vested immediately, we will assume that the same will be the same for the service that is already received and shall be recognized in it in full. If it is not vested immediately, we will assume that it will be delivered at a future date during the vesting period. Lastly, the minimum disclosure would have to be the nature and extent of share-based payment agreements that existed during the period, the disclosure of information that enables users of financial statements to understand how the fair value of goods and services are received and how equity instruments are granted during the period of recording, and disclosure of adequate information to better understand the effects of share-based payments. So, that is all for PFRS 2. Our next topic would be PAS 33, entitled Earnings Per Share. Thank you. So, the objective of this standard is to prescribe principles for determining and presenting earnings per share, otherwise known as EPS, amounts, to improve performance comparison between different entities in the same reporting period and between different reporting periods for the same entity. This simply means that the standard would like to have a consistent basis for the treatment of EPS in the past, present, and future reporting periods, and for two different entities to have the same standard for determining and presenting earnings per share. The scope of this standard encompasses all entities that wish to trade their ordinary share or potential ordinary share in the public market, or those who are in the process of issuing shares to the public. Additionally, consolidated financial statements of a group with a parent is also included as long as the previously mentioned criteria is satisfied. So regardless whether a consolidated group or an individual, they would still need to comply with this standard. Or in other words, if you ever wish to have your shares publicly traded in a stock exchange, you must first declare earnings per share and comply with this standard. So, first and foremost, it is always important to define the significant terms. Earnings per share is the profit or loss generated for each ordinary share sold. Potential ordinary share is a financial instrument or other contract that may entitle its holder to ordinary share. Common examples of potential ordinary share are convertible preferred shares, share warranties and options, and employee stock purchase plans. Dilution is a reduction in earning per share or an increase in loss per share resulting from the assumption that convertible instruments are converted, that options or warranties are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions. Anti-dilution is an increase in earnings per share or a reduction in loss per share resulting from the assumption that convertible instruments are converted, that options or warranties are exercised, or that ordinary shares are issued upon the satisfaction of specified conditions. Next would be the bread and butter for this standard, the basic and diluted earnings per share. Basically, there are two types of EPS: basic earnings per share and diluted earnings per share. Basic earnings per share deals with the net profit or loss for the period, attributable earnings or ordinary shares, and number of ordinary shares. Or it mostly focuses on what has already happened within the period. However, for diluted earnings per share, it also takes into account the possible future and makes the necessary adjustments to do so. As such, it consists of adjusted net profit or loss for the period, attributable ordinary share, and adjusted number of ordinary shares. The adjustments are made all of diluted potential ordinary shares, or in other words, we must consider the effects if all of those potential ordinary shares become ordinary shares. Also, it is important to know that while dilutive is an estimate for a basic earning per share, both are required to be presented. So let's start with a detailed discussion with basic earnings per share. To measure basic earning per share, we must first divide net profit or loss attributable to ordinary shareholders by the weighted average number of ordinary shares outstanding. For the next for the net profit or loss, it shall be made up of profit or loss attributable to the parent entity, less all expenses and after tax preference share dividends. After which we will still need to take into account the other effects of preference shares to our ordinary share. As for the weighted average shares, it consists of adjusted shares in issue at the beginning of the period by the number of shares brought back or issued during the period multiplied by the time weighting factor. Next would be the diluted earnings per share. The formula would relatively will still be the same, however, with the necessary adjustments and additions of converted diluted securities in our denominator to be added to our weighted average shares. The numerator would stay the same, however, it will be added with dividends and on diluted potential ordinary shares and interest recognized for the diluted potential ordinary shares. Other income and expenses and its effects will also be accounted for. The denominator, as mentioned earlier, is just an accumulation of the previous with additions such as warranties and options. Lastly, the disclosures, as you can see, is in the slide is clear enough, so I'll just give a brief rundown. Disclosure would be the amounts used and its reconciliations. Weighted average number of ordinary shares used, current anti-dilutive with potential future dilution. This means that instruments that could potentially be converted into a part of the dilutive earnings per share, but currently isn't, since it is recognized as a anti-dilutive. And lastly, description of share transactions after the balance sheet date. And with that, I end my piece and would like to hand you over to our next presenter, Mr. Rabuya.
Past 19 employee benefits. So employee benefits are all forms of consideration given by an entity in exchange for services rendered by employees or for the termination of employment. So for the purpose of this standard, employees include directors and other management personnel. Employee benefits include short-term employee benefits, post-employment benefits, other long-term employee benefits, and termination benefits. So what is short-term employee benefits? These are employee benefits other than termination benefits which are expected to be settled wholly within 12 months after the end of the annual reporting period in which the employees render the related service. So, it includes salaries, wages, and social security contributions, short-term compensated or paid absences, profit sharing and bonuses payable within 12 months, and non-monetary benefits such as medical care, housing, and car. Recognition and measurement. Accounting for short-term employee benefits is fairly straightforward because there are no actuarial assumptions. So, there is no requirement to discount future benefits because such benefits are all, by definition, payable no later than 12 months after the end of the current reporting period. No possibility of actuarial gains or loss because these type of benefits are measured on undiscounted basis. Accounting procedures. Unpaid short-term employee benefits at the end of the accounting period shall be recognized as accrued expense, and any short-term benefits paid in advance shall be recognized as prepayment. So, short-term compensated paid absences. An entity may pay employees for absences for various reasons such as vacations, sickness, and short-term disability, maternity or paternity, and military service. Entitlement to paid absences falls into two categories, namely accumulating and non-accumulating absences. When you say accumulating absences, these are carried forward and can be used in future periods, while non-accumulating paid absences are not carried forward. Post-employment benefits. So these are benefits other than termination benefits and short-term employee benefits which are payable after the completion of employment. So it includes retirement benefits such as pensions and lump sum payments on retirement, post-employment life insurance, and post-employment medical care. Most post-employment benefit plans are formal arrangements between an employer and the employees. These are usually established as part of a remuneration package for the employees. The plans be established by law, thereby entities are required to contribute to national benefit plans as in the case of SSS or Social Security System. Defined Contribution Plan. So it is a post-employment benefit plan under which an entity pays fixed contributions into a separate entity known as the fund. The entity will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods. So the contribution is definite, but the benefit is indefinite. In this case, the entity makes the contribution to a trustee which administers, manages, and invests the funds. Consequently, when an employee retires, the accumulated funds in the hands of the trustee determines his retirement benefit. Once the defined contribution is paid, employer has no more obligation under the plan. Accounting for defined contribution plan. Accounting for this plan is straightforward because the obligation of the entity is determined by the amount contributed for each period. So accounting procedures, so the contribution shall be recognized as expense in the period it's payable. Any unpaid contribution at the end of the period shall be recognized as accrued expense. Any excess contribution shall be recognized as prepaid expense, but only to the extent that the prepayment will lead to a reduction in future payments or a cash refund. Disclosure. An entity shall disclose the amount recognized as an expense for defined contribution plan. Defined benefit plan. Under defined benefit plan, an entity's obligation is to provide agreed benefits to employees. In other words, an employee is granted specific or definite amount of benefit which is usually related to his salary and years of services. The benefit is definite, but the contribution is indefinite. In this type of plan, the entity assumes the investment risk in a defined benefit plan. So, accounting for defined benefit plan. Accounting for this plan is complex because actuarial assumptions are required to measure the obligation and the expenses, and there is a possibility of actuarial gains or losses. In addition, the obligation is measured on a discounted basis. Defined benefit plans may be unfunded, fully funded, or partly funded by the contributions of the entity. Consequently, under a defined benefit plan, the expense recognized is not necessarily the amount of contribution for the period. Components of defined benefit cost. PAS 19, paragraph 120 provides that an entity shall recognize the following components of defined benefit cost. First, service cost, which comprises current service cost, past service cost, and any gain or loss on plan settlement. Next is net interest, and next is remeasurement, which comprises remeasurement of plan assets, remeasurement of defined benefit obligation, and remeasurement of the effect of asset ceiling. The service cost and net interest are included in profit or loss as component of employee benefit expense. All the remeasurements are fully recognized through other comprehensive income and are reclassified subsequently to retained earnings. The components on employee benefit expense. First, we have current service cost. It is defined as the increase in the present value of the defined benefit obligation resulting from employee service in the current period. It is the cost to an entity under defined benefit plan for service rendered by employees in the current year. Next is past service cost. It is the change in the present value of the defined benefit obligation for employees service in the prior periods resulting from a planned amendment or curtailment. When you say planned amendment, it includes introduction of defined benefit plan or changes to an existing defined benefit plan, while planned curtailment is a significant reduction by the entity in the number of employees covered by the defined benefit plan. Moreover, all past service costs, whether vested or unvested, shall be recognized as an expense immediately. Next is net interest. It is the change in the defined benefit obligation, plan assets, and asset selling as a result of the passage of time. It can be viewed comprising three elements: interest expense on defined benefit obligation, interest income on plan assets, and interest expense on effect of asset ceiling. Next is gain on plan settlement as deduction, and loss in a planned settlement as an addition. Other long-term employee benefits. So these are all employee benefits which are not expected to be settled wholly within 12 months after the end of annual reporting period in which employees render the related service. Examples are long-term paid absences such as long service or sabbatical leave, jubilee or other long service benefit, long-term disability benefits, and profit sharing and bonuses and deferred compensation. Next is termination benefits. So these are employee benefits provided in exchange for the termination of an employee's employment as a result of either an entity's decision to terminate the employee's employment before the normal retirement date and an employee's decision to accept an offer of benefits in exchange for the termination of employment. PAS 20 accounting for government grants and disclosure of government assistance. So PAS 20 will only be applied in accounting for a disclosure of government grants and in the disclosure of other forms of government assistance. So this standard will not be applied to any special problem arising in accounting for government grants, government assistance that is provided for an entity in the form of benefits, government participation in the ownership of the entity, and government grants covered by PAS 41. So government grants are assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So recognition. An entity shall recognize a government grant, including non-monetary government grant, at fair value when there is reasonable assurance that the entity will comply with the conditions attaching to them and the grants will be received. In addition, it shall be recognized in profit or loss. The entity shall recognize the government grant in profit or loss of the period in which it becomes receivable. So government grants related to assets are those whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. An entity shall present government grants related to assets, including non-monetary grants at fair value, and it shall be presented in the financial position by setting up the grant as deferred income and by deducting the grant in arriving at the carrying amount of the asset. So grants related to income are presented as part of the profit or loss, and a government grant that becomes repayable shall be accounted for as it changes in accounting estimate. Required disclosure for PAS 20 government grant. The accounting policy adopted for government grants, including the methods of presentation adopted in the financial statements, the nature and extent of government grants recognized in the financial statements, and unfulfilled conditions and other contingencies attaching to government assistance.
PFRS 8, which is the operating segment. So operating segments are the components of an entity about which separate financial information is available that is evaluated by the chief decision maker in deciding how to allocate resources and in assessing performance. PFRS 8 applies to the separate or individual financial statements of an entity and to the consolidated financial statements of a group with a parent whose debt or equity instruments are traded in a public market and that files or is in the process of filing the consolidated financial statements with the Securities Commission or other regulatory organization for the purpose of issuing any class of instruments in a public market. So, however, when both separate and consolidated financial statements for the parent are presented in a single financial report, segment information need be presented only on the basis of the consolidated financial statement. Under PFRS 8, an operating segment is a component of an entity that engages in business activities from which it may earn revenues and incur expenses, or whose operating results are regularly viewed by the entity's chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance, and for which discrete financial information is available. So, We should take note that not all operations of an entity will necessarily be an operating segment nor part of one. So, for example, the corporate headquarters or some functional departments may not earn revenues, or they may earn revenues that are only incidental to the activities of the entity. So next is the chief operating decision maker. So the chief operating decision maker defines the purpose of allocating resources to and assessing the output of an entity's operating segments. So the chief operating decision maker of an entity is often the chief executive officer or chief operating officer or a group of executive directors. Thresholds for reportable segments. So if an operating segment has a similar economic characteristics, they exhibit similar long-term financial performance. So for example, similar long-term average gross margins for two operating segments would be expected if their economic characteristics were similar. So two or more operating segments may be aggregated into a single operating segment if aggregation is consistent with the core principle of PFRS 8. So the core principle of the PFRS 8 is that an entity should disclose information to enable users of its financial statements to evaluate the nature and financial effects of the types of business activities in which it engages and the economic environments in which it operates. Next is the segment have similar economic characteristics, and the segments are similar in each of the following aspects: the nature of the products and services, nature of the production process, type or class of customer for their products and services, and if applicable, the nature of the regulatory environment. So, segment information is required to be disclosed about any operating segment that meets any of the following quantitative thresholds. So first is its reported revenue, including both sales to external customers and inter-segment sales or transfers, is 10% or more of the combined revenue, internal and external, of all operating segments. Second is the absolute amount of its reported profit or loss is 10% or more of the greater in absolute amount of the combined reported profit of all operating segments that report a loss. Then lastly is its assets are 10% or more of the combined assets of all operating segments. So we should take note that an additional operating segment will be identified as reportable segments if the total revenue reported by the operating segment is less than 75% of the entity's revenue until at least 75% of the entity's revenue is included in reportable segments. An entity shall disclose information to enable users of its financial statements to evaluate the nature and financial effects of the business activities in which it engages and the economic environments in which it operates. So the reporting entity is required to disclose the following: the general information and the information about reported segment profit or loss, including specific revenues and expenses included in reported segment profit or loss, segment assets, segment liabilities, and the basis of measurement. Next is the entity-wide disclosures, which are the products and services, geographical area, and the major customers. Interim financial reporting. So, an interim financial report is a complete or condensed set of financial statements for a period shorter than a financial year. So, PAS 34 does not specify which entities must publish an interim financial report. So that's generally a matter for laws and government regulations. The objective of PAS 34 is to prescribe the minimum content of an interim financial report and to prescribe the principles for recognition and measurement in complete or condensed financial statements for an interim period. So according to the book, timely and reliable interim financial reporting improves the ability of investors, creditors, and others to understand an entity's capacity to generate earnings and cash flows and its financial conditions and liquidity. So PAS 34 applies in accordance with the Philippine Financial Reporting Standards, or the PFRS, if an entity is required to publish an interim financial reporting. So the IASB, or the International Accounting Standards Board, encourages public traded entities to provide interim financial reports that conform to the recognition, measurement, and disclosure principles set out in PAS 34. For the general concepts, the PAS 34 does not mandate which entities should be required to publish interim financial reports, like how frequently or how soon after the end of an interim period. So, however, government, securities regulators, stock exchanges, and accountancy bodies often requires entities to publish interim financial reports. So, if an entity's interim financial report is in compliance with PAS 34, that fact shall be disclosed. So, an interim financial report shall not be described as complying with PFRS unless it complies with all the requirements of PFRS. So, it does not require full compliance with the provisions of PAS 1 in the preparation of interim financial reports. So, it may be required to provide less information at interim dates compared with its annual financial statements. An interim financial report comprises the minimum components of condensed statement of financial position, condensed statement of profit or loss and other comprehensive income, condensed statement of changes in equity, condensed statement of cash flows, and the selected explanatory notes. So if an entity uses the two-statement approach in preparing the statement of comprehensive income and presents items of profit or loss in a separate statement, it should then present interim condensed information from that standard. So, if an entity publishes a set of condensed financial statements in its interim financial reporting, those condensed statements shall include each of the headings and subtotals that were included in annual financial statements and explanatory notes. Then next is the additional line items or notes should also be included if their omissions would make the condensed interim financial statements misleading. So, should also include an explanation of events and transactions that are significant to an understanding of the changes in financial position and performance of the entity since the end of the last annual reporting period. An entity shall present basic and diluted earnings per share for that period in a statement that presents the components of profits or loss for an interim period. So if an entity presents items of profits or loss in a separate statement, it presents basic and diluted earnings per share in that statement. So even if the preparation of a consolidated financial statement is difficult and time-consuming, it does not excuse entities from preparing interim financial reports on a consolidated basis. So an interim financial report is prepared on a consolidated basis if the entity's most recent annual financial statements were consolidated statements. For the recognition and measurement of the interim financial statements, materiality is used to assess in deciding how to recognize, measure, classify, or disclose an item. So, in assessing a materiality, judgment is always required. Okay, so next is that an entity shall apply the same accounting policies in its interim financial statements as are applied in its annual financial instruments, except for accounting policy changes made after the date of the most recent annual financial statements that are to be reflected in the next annual financial statements. An interim periods covered by the interim financial statements are the statement of financial position as of the end of the current interim period and as of the end of the immediately preceding financial year. Second is the statement of profit or loss and other comprehensive income for the current interim period and cumulatively for the current financial year to date, with comparative statements of profit or loss and other comprehensive income for the comparable interim period of the immediately preceding financial year, and then for the statement of changes in equity cumulatively for the current financial year to date and statement of cash flows cumulatively for the current financial year to date, with a comparative statement for the comparable year-to-date period of the immediately preceding financial year. There are two ways of viewing interim periods: the independent reporting periods and the mere part of a larger financial year. So, independent reporting periods is one way of viewing interim periods when it concludes the requirements that an entity should apply the same accounting policies in its accounting financial statements as its annual statements, and it is also viewed as a mere part of a larger financial year if PAS 34 provides that the frequency of an entity's reporting shall not affect the measurement of its annual results. So the interplay of the two views of an interim period are illustrated in the following. The principles for recognizing the measuring losses: a cost that does not meet the definition of an asset and at the end of an interim period is not deferred in the statement of financial position. Then lastly is the income tax expense is recognized in each interim period based on the best estimate of the weighted average income tax rate expected for the full financial year. For the disclosure of the PAS 34, it shall disclose the interim financial statements and be incorporated by cross-reference from the interim financial statements. So, if PFRS 8 requires to disclose segment information in its annual financial statement, disclosure of segment information is required. So, the following are the covered entities that must provide the following segment information. First is the revenues from external customers, if included in the measure of segment profit or loss, reviewed by the chief operating decision maker. Second is the inter-segment revenues, if included in the measure of segment profit or losses, reviewed by the chief operating decision maker. Then third is the measure of segment profit or loss, followed by the measure of total assets and liabilities for a particular reportable segment. Fifth is the description of differences from the last annual financial statements in the basis of segmentation or in the basis of measurement of segment profit or loss. And lastly is the reconciliation of the total of the reportable segments measures of profits or loss to the entity's profit or loss before tax expense and discontinued operation.
Hello, good day. I'm Johanna Catay, and in this video, I will be tackling about past 10 events after the reporting period. Past 10 has two main objectives. Number 1 is to prescribe what an entity should adjust its financial statements for events after the reporting period. And number 2, what disclosures that should be given about the date when the financial statements were authorized for issue and about the events after the reporting date. Therefore, past 10 scope shall be applied in the accounting for and disclosure of events after the reporting period. What are the events after the reporting period? Those are events that are favorable and unfavorable that occur between the end of the reporting period and the date when the financial statements are authorized for issue. We need to determine when the event happened in order to say whether past tense applies or not. Past tense constitutes two types of classification of events after the reporting period, and these are number 1, adjusting events, and number 2, non-adjusting events. The first classification is adjusting events, and these are events occurring after the reporting date that provide evidence of conditions that existed at the end of the reporting period. From its title, adjusting, we will make some entries as a result of those events. In other words, these events might have happened after the end of the reporting period, but they were a result or a consequence of something already in existence. Thus, if events are identified, then there is a need to adjust the amounts recognized in the financial statements to reflect these events. Provided below are some of the examples of adjusting events in past tense. These are settlement of outstanding court case that confirm the entity had a present obligation at reporting date. Next is the bankruptcy of a client that occurs after the reporting date that confirms a loss existed at reporting date on trade receivables. Next is sale of inventory at below cost that give evidence about their net realizable value at reporting date. Next is the determination of purchase or sale price of property, plant, and equipment or PPE. Next is the receipt of information after the reporting date indicating that an asset was impaired at reporting date. And the next would be the discovery of fraud or errors that show the financial statements are incorrect. The second type of events after the reporting period is non-adjusting events, and this is an event that occurs after the reporting date that do not provide evidence of conditions that existed at the end of the reporting period. In this case, we do not adjust the financial statements compared to the adjusting events. Thus, non-adjusting events provides no bookkeeping. If the events are material, then provide disclosures in the financial statements about the nature of event and estimates. These are some of the examples of non-adjusting events provided in past tense. These are fall in value of investments, major purchase of assets, announcing a discontinued operation, announcing a reconstruction, dividends declared after the end of the reporting period, and natural disasters. But please take into account that there are some of examples of non-adjusting events provided in past tense. These examples that I provided are some of the examples. For the recognition and measurement of adjusting events and non-adjusting events. So, we should always take into account when it is adjusting and non-adjusting. If it is adjusting, remember adjusting, then the entity should adjust the amounts recognized in its financial statements and add relevant disclosures that would reflect the events. While if it is non-adjusting events, then the entity should not adjust the amounts recognized, but the entity should disclose the events when and only when it is material about the nature of events and the estimates. Note that an entity shall not prepare its financial statements on a going concern basis. if management determines after the reporting date that entity intends to liquidate or to cease trading, or when the entity has no realistic alternative but to do so. As for the disclosures, an entity shall present and disclose information that enables users of the financial statements to evaluate the effects of events after the reporting period. So in the notes to the financial statements, letter A, an entity shall disclose the date when the financial statements were authorized for issue and who gave that authorization. If the entity's owners or others have the power to amend the financial statements after issue, then the entity shall disclose the fact. Letter B, if an entity receives information after the reporting period about conditions that existed at the end of the reporting period, it shall update disclosures that relate to those conditions in the light of the additional information. Letter C, in some cases, if an entity needs to update the disclosures in its financial statements to reflect information received after the reporting period, even when the information does not affect the amounts that it recognizes in its financial statements. And lastly, if non-adjusting events after the reporting period are material, the non-disclosures could influence the economic decisions that users make on the basis of the financial statements. Accordingly, an entity shall disclose the following for each material category of non-adjusting event after the reporting period. These are the nature of the event and the estimate of its financial event, or a statement that such an estimate cannot be made. So, that's it for past 10 events after the reporting period. And I hope that you have learned and understand this standard completely. Thank you for listening.
That's it.
And
We hope that you learned something from our discussion.
Have a great day ahead. Merry Christmas and have a happy New Year.